Hi, this is CH. This video is part of a series of videos titled My ABCs, or Absolutely Biased Comments, to share how an individual investor like you and I can try to find out more about an investment fund from public sources and do some basic research or simple due diligence before deciding to buy the fund or walk away. Do explore the other funds covered in this series and subscribe to the channel if you find this video useful. Some quick disclaimers before we start. This is not a product sales pitch or a recommendation to buy. I'm not sponsored by anyone to do this video. Please do your own research and be clear about the product features and risks before taking any action. The information shown and mentioned in this video is accurate as of the date stated here. In this video, I will be talking about the Amundi Index MSCI Emerging Markets Fund, which is a passive indexing fund. This video is done as a follow-up request from a viewer's comment in my previous video covering the Amundi Index MSCI World Fund. If you would like me to cover any funds or ETFs, do drop me a comment in any of my videos and I'll be happy to work on it as long as I can find enough information on the product. Before we get into the fund details, let's first understand what is a passive indexing fund. Viewers who have seen this section in my other videos can skip to the next section. Traditional mutual funds are actively managed. There is a fund manager with a team of investment specialists who actively manages the fund with the intent to outperform the market or the index the fund uses as a benchmark. As such, the fund manager and his team does a lot of research and analysis work to try figure out how to generate the outperformance, and therefore, there is a higher cost involved in the form of management fees. Traditional mutual funds are also traded directly with the fund provider, meaning the liquidity is controlled by the fund provider, who can create and remove shares or units according to the transaction flows. These funds have a fixed NAV every day that is used for the subscriptions and redemptions, so everyone who trades on the same day get exactly the same NAV. Traditional ETFs have the opposite characteristics. The ETFs are passively managed with the intent to replicate as close as possible the specified index that represents the market. Given there is no requirement to outperform or to evaluate the underlying constituents of the index, ETFs require a much smaller investment team with less work involved, so the costs involved in the form of fees are also lower. ETFs, as the name implies, are listed and traded on stock exchanges just like public equity stocks. Therefore, the liquidity is mainly determined by the supply and demand available on the exchanges. An investor can only buy an ETF if there are shares or units being sold on the exchange. ETF providers can create and remove shares or units, but usually do so for large trades only. Given the trading is done on stock exchanges just like a stock, trading can be done anytime while the exchange is open, and the trading prices will have a premium or discount gap versus the NAV. There are some active fund managers who prefer to run their products on stock exchanges and provide liquidity like stocks. These are termed as active ETFs or actively managed ETFs. The famous, or some say infamous, ARK Invest ETFs fall into this category. There are also some mutual funds that have a portion of their portfolio made available on stock exchanges as an additional trading vehicle for various reasons. These are termed as closed-end listed funds and generally have only a limited number of shares available for trading on the exchange, so they tend to exhibit a higher premium or discount gap versus the NAV. For example, BlackRock has a closed-end listed fund called BlackRock Income Trust on the US stock exchange that is similar to its US mortgage-backed securities mutual funds. Separately, looking purely at the classifications here, this is also valid for investment-focused companies such as Berkshire Hathaway. Flipping the combinations gives us passive indexing funds that are really similar to traditional ETFs that simply tracks and replicates an index, but in this case, the fund provider creates the product in a mutual fund structure instead of listing it on an exchange. The Amundi Index MSCI Emerging Markets Fund that we are covering in this video falls under this category. As a passive indexing fund, the Amundi Index MSCI Emerging Markets Fund tracks and replicates the MSCI Emerging Markets Index, which is the most popular developing equity market or emerging equity market index used in the financial and investment world. MSCI is a US-based financial company that specializes in providing market indexing business and investment portfolio analysis tools. While the indexing business covers fixed income and real estate asset classes as well, MSCI is best known for its equity indices, in particular the popular MSCI World Index series. While the MSCI Emerging Markets Index is commonly used as a benchmark to represent non-developed equity markets, it actually does not cover all the markets available. MSCI categorizes equity markets of countries into three categories. MSCI World includes 23 developed markets countries. MSCI Emerging Markets includes 24 emerging markets countries. And MSCI Frontier Markets includes 28 frontier markets countries. The MSCI Emerging Markets Index covers about 1,200 stocks that represents about 85% of the free float adjusted market capitalization of those 24 countries. So there will be no small cap exposures in this index. Other popular related MSCI indices include the MSCI All Country World Index or ACWI, that is basically a combination of all the 23 countries covered in MSCI World Index plus all the 24 countries covered in MSCI Emerging Markets Index. Also related is the MSCI AC Asia ex-Japan Index, that is a combination of 2 countries from MSCI World Index and 8 countries from MSCI Emerging Markets Index, and also the MSCI EM Asia Index, that is simply the 8 countries from MSCI Emerging Markets Index. Given the MSCI Emerging Markets Index uses free float market cap to determine allocation weights, the index is currently heavily exposed to Asia countries because a few of these countries like China plus Hong Kong, India, Taiwan, and South Korea have significantly larger market by size compared to the rest of the EM countries. The free float criteria reduces some China companies that are mainly state-owned, though the remaining exposures are still quite significant. The next few countries on the list that are outside of Asia will be Brazil, Saudi Arabia, and South Africa, representing Latin America, Middle East, and Africa regions respectively. As a result, the index currently has 29% China, 19% Taiwan, 17% India, and 11% South Korea, adding up to a total of over 76% allocation to just these 4 Asian countries. Brazil is next on the list, though it only has 4% allocation. At the same time, because the leading companies in these 4 countries tend to be technology and financial related, the result is that the sector breakdown of the index has about 25% technology and 24% in financials. Even the next 2 sectors of 13% consumer discretionary and 10% communication services are actually comprising mostly of tech-related names like Tencent and Alibaba because of the way they are classified. This also results in a high overlap between MSCI Emerging Markets Index and MSCI AC Asia ex-Japan Index, leading to the question of whether that 1/4 of allocation to non-Asia countries is enough to make a difference in performance for MSCI Emerging Markets exposure. And we will explore that later. Now that we understand the index better, let's take a look at the fund itself. Amundi is a French asset management company founded in 2010 from the merger of the asset management businesses of Crédit Agricole and SocGen, 2 of the leading financial institutions in France. Crédit Agricole has 80% ownership of Amundi, while SocGen has 20%. Amundi IPO'd in 2015 in the Paris Euronext and has been growing strongly through organic business growth as well as multiple acquisitions. Today, Amundi manages over 2.2 trillion euros worth of assets, making it the largest asset manager in Europe. Amundi's businesses are well diversified. Client base covers the full spectrum from retail and private banking through third-party distributors, to insurers, to sovereigns, and institutional. Europe, with France in particular, obviously covers the bulk of the business, though Amundi has been relatively successful in Asia with about 20% of AUM from the region. Product diversification-wise, about half are actively managed products, while 20% are passive solutions, which is where this fund falls under. The Amundi Index MSCI Emerging Markets Fund is a sub-fund under the Amundi Index Solutions fund family. Amundi Index Solutions is set up as a Luxembourg SICAV structure and is UCITS qualified. It essentially covers a long list of passive indexing funds that are too many for me to count, of which only a handful of funds are offered in Singapore as MAS recognized schemes that are suitable for retail investors. There should be a Singapore addendum on top of this Luxembourg prospectus that is not yet published as of this video because the prospectus was just recently updated. As mentioned earlier, the Amundi Index MSCI Emerging Markets Fund is a passive indexing fund, meaning it tracks the performance of the MSCI Emerging Markets Index. Given it is in a mutual fund format and has only one NAV per day, it actually more specifically tracks the closing price of the MSCI Emerging Markets Index. There are also some details of the index itself in the investment policy of the fund within the prospectus, most of which were covered earlier. The index is rebalanced quarterly and the fund will follow accordingly. The fund uses a synthetic replication approach, meaning it will not invest directly in the stock constituents of the index, but will instead invest in financial derivatives, or more specifically total return swaps, to replicate the performance of the index. This is because the markets and specific stocks in some of the countries in the index may be difficult to access, and that the fund may want to minimize handling of some of these local currencies that may be too volatile to take direct exposures in. Synthetic replication approach is quite common in indexing solutions, and here it is stated the fund anticipates tracking error to be within 1%, so it shouldn't lead to any significant performance gaps versus the index. Given this is in a mutual fund structure, NAV is calculated once daily on forward pricing basis, so all trades for the day get exactly the same NAV. Settlement is 3 days after the dealing day. Similar to the other Amundi Index funds offered in Singapore, this fund comes with two share classes, which are the A12UC and A12SC. A refers to retail share class. 12 is an internal number that means the share class is limited to particular investors, distributors, or countries. U is for US dollars and S is for Sing dollars unhedged. C refers to capitalization, which means accumulation class. These two share classes were only launched in March 2022, so the available track record is actually quite short for us to do performance assessment. As a passive indexing fund, fees tend to be low with total expense ratio or TER at just 0.2%. Given the nature of the fund and that the TER is already so low, there is no trailer fees that can be shared out, and therefore some distributors may not carry this fund. Amundi allows distributors to charge up to 4.5% subscription fees, although as an investor, you should ask for the same rate as with normal ETF transactions. Fund size is currently almost $7 billion US dollars, which looks pretty big, as I had thought there wouldn't be that much interest in MSCI EM exposure. That being said, I think majority of the assets are in share classes that are offered outside of Singapore. Given the fund uses synthetic replication approach, the fund does not show any portfolio details, but instead provides the index information such as country and sector breakdown, as well as top 10 holdings. Here, we can see a more elaborate country breakdown that again shows the overwhelming allocation of the top 4 countries versus the other 20 in the index. The Amundi Index MSCI Emerging Markets Fund Fact Sheet provides a cumulative performance chart and data tables of the fund and the benchmark, so it is good for investors to quickly see how well the fund tracks the index. Looking at the performance chart and the longer time period data, it shows that the fund seems to be tracking the index quite closely, with about a 0.4% per annum gap. Given the fund's expense ratio is 0.2%, that means the fund is lagging on performance by about another 0.2% per annum, which doesn't sound too bad. However, For time periods of 1 year or less, the fund is actually having a rather large gap from the index of around 1.4%. This is quite significant for a passive indexing tracking strategy, so there is obviously some inefficiencies in the synthetic replication approach or the pricing approach used by the fund. The actual tracking error also shows a significantly larger number than the anticipated 1% mentioned in the prospectus. Let's explore this tracking error problem by comparing with some of the popular MSCI emerging markets ETFs available on Morningstar charts. Here we have US listed iShares and also Europe listed Invesco, Spider, UBS, and Xtrackers. In this 1 year chart, it is quite clear that while the ETFs appear to be performing almost identical, Amundi is the only odd one out with the frequent gaps through the whole time period. While in the long run the fund appears to recover after each gap and move back in tandem with the rest, this frequent gap will pose a problem when trading because it is happening so often and this potentially results in a notable performance difference. This also shows that it is not the problem of synthetic replication versus physical replication approaches, because Invesco is also using synthetic replication approach and appears to be having similar performance line as with the others. So therefore, this clearly has something to do with the approach of the total return swaps used or the pricing methodology used for NAV calculation in the fund. But unfortunately, there is no explanation or clarification available from Amundi. The tracking error and performance gap is also showing quite clearly in short time periods like the 1 month chart here, with Amundi delivering about a 1% to 1.5% lower return than the ETFs in each gap. Due to this problem, I would not suggest to consider using this fund for MSCI EM exposure. Next, let's take a look and see if there are any meaningful differences between emerging markets and Asia coverage. Here, I retain Amundi and Spider MSCI EM UCITS ETF and added in iShares and Spider tracking MSCI EM Asia Index and UBS tracking MSCI AC Asia ex Japan Index. Now remember, MSCI EM has about 3/4 of Asia exposure and dominated by China, India, Taiwan, and South Korea. So looking at this chart that is showing the period since inception of Amundi Fund, we can hardly see any difference between these 5 products. They are actually covering 3 different MSCI indices. Even looking at a shorter 1 year chart, we can hardly see any differences between the Asia products versus the EM products. So at least in the near future, investors going for MSCI EM Asia or MSCI AC Asia ex Japan indices type of market coverage won't have any meaningful differences versus going for MSCI EM coverage. This will only change if Latin America or Middle East economies grow significantly and take up larger allocations in the indices, but I don't see that happening at least in the next 5 years. What this basically means is that US dollar investors can opt for Asia equity ETFs or funds because there are a wider range of varieties available to pick and choose, or otherwise at least go for a MSCI EM ETF because the ETFs have notably less tracking error than the Amundi fund. What about Sing dollar investors? The Amundi Index MSCI Emerging Markets Fund comes with a Sing dollar unhedged class. And we can see in this chart that there are some differences in the performance track record due to FX. There are, however, currently no EM Asia or Asia ex Japan ETFs in the market that are traded in Sing dollars. So looking for a passive index tracking comparison is difficult. Therefore, Sing dollar investors who really want a passive exposure to MSCI EM will probably have to rely on this fund. Otherwise, Sing dollar investors can also consider to look towards active funds. For example, M&G Global Emerging Markets Fund shows a decent outperformance in the past 3 years for its Sing dollar unhedged share class. Of course, the risk here is that an active fund may also underperform the index at times, so this really depends on what individual investors are looking for. With that, let's summarize our findings. Amundi is an established global asset management firm and the largest asset manager in Europe. About 20% of its AUM is in passive solutions. The Amundi Index MSCI Emerging Markets Fund passively tracks the MSCI Emerging Markets Index, which is the most popular non-developed equity market index used in the financial and investments world, even though it actually covers only 24 countries. Given the current global economic situation, MSCI Emerging Markets Index has about three-quarter exposure in Asia, and in particular in four countries that are China, India, Taiwan, and South Korea. As such, there is currently no notable performance differences compared to MSCI EM Asia or MSCI AC Asia ex Japan indices. This means MSCI Emerging Markets Index currently does not give much diversification benefits outside of Asia exposures. The fund charges a low 0.2% TER, which is comparable to most ETFs in the same category. The share classes offered in Singapore have a relatively short track record, having incepted only in 2022. The biggest issue with the fund is its performance that shows some tracking error problems, especially in the recent 1 year, leading to frequent performance gaps that can be as big as a 1.5% single-day lag compared to ETFs. While the gaps appear to recover quickly and in the long run the fund delivers a similar return as the ETFs, these gaps can cause meaningful entry or exit point differences, which is bad for investors. As such, the Amundi Index MSCI Emerging Markets Fund is not a good product for investors looking to get MSCI EM exposure. For US dollar investors, there are plenty of ETFs with lower tracking errors, and there are also ETFs with Asia exposures that can be considered given high similarities in performance. For Sing dollar investors, there is a lack of choice in passive solutions, although it may be worthwhile to consider active solutions if they make sense. This concludes my absolutely biased comments on the Amundi Index MSCI Emerging Markets Fund. Again, if you find this video useful and would like to see more related contents, please subscribe to the channel. Thank you and have a great day.